The latest just in a string of moves to support the economy.
Absolutely. And the stock market kind of seen as a proxy, obviously, to the economic woes seen in China. You can bring up a number of different stock charts to show that it's down about 8%. The CSI 300 down about 8% over the last month. It's down about 12% since its peak this year on January 30th, and down 36% since the peak that we saw back in February of 2021 through the pandemic, down 36%. So it's lost a third of its value. So that, again, is a kind of a proxy to all the weakness. But then the news flow has been very negative. We've had the ongoing property sector problems. We've had trust defaults and, of course, weak consumer sentiment. So domestically, there's a mattress mentality. People are sticking their money under the proverbial mattress, not spending, not buying stocks. And then foreign investors are not buying into China because of slew of weak news and also weak sentiment and geopolitical concerns. You've had foreign investors into China being net sellers for 13 consecutive weeks, 13 consecutive sessions through Wednesday. That's the longest streak ever. So you can see all that is anecdotal, but also very data-driven evidence that the Chinese authorities need to do more. And that's what they've done. Two different agencies coming out with easing measures. You have the Ministry of Finance coming out and saying we need to invigorate capital markets and boost investor confidence, to say the least, for sure. So they're going to be cutting, as of today, the stamp duty by half from 0.1%, this is on stock trading, to 0.05%. Whether that encourages the largely retail market in China to take that money out of the mattress and put it into a falling knife, that's yet to be seen, obviously. Then we also had separately the CSRC, the securities regulator, saying that because of recent market conditions, it is essentially going to, at least temporarily, put a moratorium on new initial public offerings. It didn't give the reason as to why that might boost the market, but obviously it doesn't do a lot for sentiment when new issuances perform pretty badly. Also, it kind of keeps money from flowing out of fundamental stocks and into these new issuances. So a couple of moves by authorities in China to try and stem that rout in stocks. Is it enough, though? Again, that's the big question.
And of course, we had industrial profits data over the weekend. No kind of meaningful surprise, right? What does it tell us? I guess just another puzzle piece in terms of what this weak recovery is looking like.
Absolutely. It just shows a further deceleration of profits in the industrial sector. Yes, it wasn't as bad as June. So we had industrial profits falling 6.7% year over year in July versus 8.3% in June. So not as bad. But again, through the first 7 months of this year, it's down 15.5%. Not as bad again on year-ago levels of 16.8% year-ago numbers. But again, it just really shows China's economic recovery lost further momentum in July. Weak recovery and deflationary risk. Deflationary risks are a big issue here. Remain an overhang on this industrial sector. Yes, in July there was heavy rains in many parts of China. There was flooding, so that dampened output. But again, the overall sentiment is weak demand, and that leads to weak production and weak profits.